We're in a moment where the core consumer financial services law on the books hasn't changed, but how risk shows up and business plans are changing too. So federal agencies might be quieter, but the states and private actors are louder. Compliance decisions amidst innovation and product development is increasingly requires judgment rather than direction. Greetings and welcome to Venable's Consumer Financial Services Outlook 2026. Thank you for joining us. It's Wednesday, January 28th, 2026. I'm Jonathan Pompan, a partner at Venable and chair of our Consumer Financial Services Practice Group. Today's program is designed as an outlook, grounded in experience, not just predictions. It's a grounded assessment of how regulatory enforcement and operational risk is actually showing up as we move into the year. We're focused less on what regulators might announce next and more on what they are doing or not doing and what that means in practice for compliance teams, business leaders, and boards. But before we begin, some administrative notes. Today's presentation is being recorded and is going to be available on the Venable website and also on YouTube. Today's discussion is for general informational purposes only. It's not legal advice. So contacting Venable, sending questions later for us to respond to, which we're happy to receive, does not create an attorney-client relationship, and we cannot receive client or general confidential information to your business in this forum or externally. And if you find the content useful and you're not already a subscriber to our publications, since this is going to be on YouTube, please like the video by pressing thumbs up, subscribe, hit the notification bell so you don't miss future programs, and feel free to sign up for our newsletter, the CFS Digest, and other articles and publications on venable.com, or using the links that are going to be in the description on YouTube, as well as in the emails that attendees are going to be receiving. It's the helpful content that our teams do all the time, and members enjoy putting together the content, and certainly we welcome any feedback as well. Now, for those that are here today for CLE credit, as well as also the important information we're going to be sharing, the program's been approved in California and New York. The CLE code is going to be distributed halfway through the program, thereabouts, and at the final portion, at the very end of the program, along with submission instructions. Those are going to be sent via email after the program within a few days. Now, today I'm joined by my colleagues across Venable with deep experience in consumer financial services, payments, fintech, policy, and regulatory environment. First, my partner, Andrew Bigart.
Hi, everyone, and thanks for joining us today.
Also, Chris Boone.
Hey, good to be here.
Our newest colleague, Jim Williams, who joins us from the fintech world in-house.
Hey, everybody, great to be here. Thanks for joining.
Our partner, Mike Bresnick.
Good afternoon.
And our senior legislative policy analyst, Sarah Donovan.
Everyone, thank you.
Thanks, Sarah. Today, we'll begin with Congress and the president because tone, priorities, and institutional dynamics still matter, even when legislative bandwidth might be limited. This is not about sweeping statutory change, although there are some significant ones that may still occur this year. It's really about the dynamics at play and what is happening both and being signaled by Congress, the administration, and how they are going to shape the landscape going forward. The context helps explain why the federal regulatory posture looks the way it does. And again, in some notable areas, there's going to be some potential developments that we'll get an update on. From there, we'll walk through the federal regulatory posture and supervision. It's certainly been a significant shift since prior years. And we'll talk about what has changed, what hasn't, and where federal consumer finance risk still shows up despite reduced activity. We'll then turn a little bit to the states, which for many organizations has become the primary source of regulatory energy, potential enforcement, and exam pressure. And then next, we'll also then talk about payments and infrastructure, where consumer protection, technology, liability allocation increasingly intersect. And from there, we'll cover cryptocurrency and digital currency. It's now less about novelty or perhaps even innovation, and more about how now a familiar product and service is going to be intersecting with the consumer protection frameworks that already exist, as well as also new obligations and new opportunities that exist there. And from there, we're going to take a step back and look generally at where scrutiny is clustering in some particular product and service areas and sectors. And finally, we'll end up closing with transactions, partnerships, and structural considerations, and a short watch list for 2026. So the agenda really reflects where risk is moving, not just where some of the headlines might be. And now we'll talk a little bit and learn more about what's happening with the Congress and the President from Sarah Donovan.
Hey, Jonathan, I've lost my voice a little bit, so if I don't sound like myself today, that's why. Let's jump right in. To understand what's happening in Washington right now, the most important thing to know is that everything we're talking about here today is you should really view it through the lens of the 2026 midterm elections that are this November. Virtually every decision, whether it's legislative, executive, regulatory, political, all those things are being evaluated based on how it will impact the control of Congress. And this matters for consumer financial services because it affects what can get done. President Trump is deeply focused on the midterms. He's got $1.5 billion in cash, and he's entering legacy mode. The House of Representatives, you probably read about this in the papers, has the thinnest margin possible right now. Right now, it's a one vote margin for the Republican majority, one vote. When they are at full strength, this is after special elections and things like that, the balance in the House will be 220 to 215, which means that Republican leadership can only lose 2 votes on any bill. There's been a lot of chatter about redistricting efforts in states around the country. Those may ultimately be a wash, honestly, because of the pluses and minuses in the blue and red states. It'll probably shake out somewhere around plus or minus 3 seats in either direction, but not as big of an impact as maybe people were expecting this summer. So the bottom line is when it comes to the balance of Congress, the Senate is expected to remain Republican controlled, and the House is likely to flip to Democratic control. And this tracks with history, despite redistricting and everything else. Presidential approval rating is exactly in line where it's been in past administrations. So Trump is right in line with his predecessors. That includes Obama in their second term at this point. Let's talk a little bit more about Congress. Congress is changing rapidly. There's been a historic number of retirements announced on both sides, 54 in the House alone. And this does not count deaths or early departures for people that have resigned for other reasons. So over a quarter of Congress will be new next year. This level of turnover is really something that impacts the way that Congress operates dramatically. It weakens institutional memory, makes coalition building harder, slows legislative momentum. It means a significant amount of work to be done by stakeholders, including companies like yours, in order to educate new members and staff about the issues and how you want them to think about it. So the practical takeaway, based on this being a midterm election year, is that we should expect very limited legislative output before the midterms. That is always the case, and that will be true again this year. And that environment drives not just what issues are raised, but how they're pursued. And so we're going to talk about that next, if you want to advance, Jonathan. In this environment, we are going to see more oversight and executive and regulatory action rather than legislation. That doesn't mean we won't see any, but that's going to be the primary driver of change. Hearings, investigations, enforcement actions, this and a signature of this administration, in particular public pressure, these become the primary tools to make policy changes. Let's talk a little bit about the differences between the first Trump administration and the second. And during Trump 1, he surrounded himself with people who, in his view, legitimized his presidency, so maybe familiar names, but he didn't trust them. This time around, he surrounded himself with people that he does trust. And as a result, when members of Congress, leadership, or staff talk to their counterparts at the White House, they know that they have the ear of the president. And that's important for building trust and being able to coordinate effectively. And that triangulation between House and Senate and White House has really allowed for the information flow and the way that they influence one another. It is a bit different than the first go around. Affordability has been a central political theme heading into the midterms. And really, it's the rationale and the reasoning, or the reason why the president has publicly called for things like credit card APR caps, more specifically for credit card interest rates to be capped at 10% across the board for a year. And he's also called for the Credit Card Competition Act, otherwise known as CCCA, and that would require credit card issuing banks with assets over 100 billion to enable at least 2 unaffiliated payment networks on credit cards. These issues resonate politically. I mean, that's what this is about. Remember, we're talking about the midterm elections. We're talking about politics. We're talking about the balance of power. And these issues notably do not fall along party lines. This is one of those political horseshoe moments that you hear about where the president is calling for something that AOC has called for and Elizabeth Warren and the president are talking. I mean, it's just like, it's one of those moments. And even if the legislation codifying any of these proposals doesn't move, there's hearings, messaging bills, public and regulatory pressure. Those can have an impact. We saw this with the pharma companies where there wasn't a direct legislative or executive or even administrative action, but there was this public pressure campaign and there were changes made on drug pricing. For consumer financial services, that is going to put housing, credit products, fintech, digital assets, those issues squarely in focus. And my partner, Chris Boone, is going to go deeper into crypto and digital assets later. But I'll just say this now. Digital assets are much more important than traditional financial services on the congressional agenda. That's just how they're prioritizing their time and effort. And that's to say nothing of the administration. Which is really a big, the Clarity Act in particular has been a big priority for the administration, and that bill's working its way through Congress. The Clarity Act, for those unfamiliar, creates a regulatory framework for digital assets. We talked about credit card interest rate caps. I'll say this, it currently lacks support on both sides of the aisle. It's a fairly straightforward issue, and members seem to understand the negative impacts it would have on the economy. So that one, maybe it's one of those public pressure moments we have to see. On CCCA, it's less well understood. And I identify this because in my opinion, there's a higher risk here. If that's something that you're opposed to, perhaps not. In my opinion, there's a higher degree of likelihood that moves for a variety of factors. And there's a significant amount of education that needs to be done with new members and staff for them to understand what that bill would do. So now that we've framed the environment and given context to these various issues, I'm going to turn it back to Jonathan so that he can lead us on the regulatory posture.
Sarah, thank you very much. And now that we've covered the political and legislative context, let's now turn to that and how that environment is translating into regulatory activity, or in some cases, inactivity. At a high level, federal consumer financial law remains in force. It's unchanged. The federal statutes haven't moved at all. What has changed is posture and capacity, and in some cases, the intentionality of the organizations that regulate consumer financial services at the federal level. Some initiatives are formally paused or under review. Others remain on the books but remain inactive. And outcomes increasingly depend on whether agencies choose to act rather than whether they still have the authority to do so. So it's not deregulation in the classic sense. It's really a recalibration driven by leadership, resources, and political constraints or interest. So the law hasn't disappeared, but posture and capacity really has shifted. When we talk about federal regulatory posture at a high level, the federal consumer financial law is very much still in place, but the regulatory risk today is uneven. It hasn't been eliminated. It's just showing up inconsistently across agencies, products, and different markets. The outcomes, I think, really depend less on headlines or formal announcements, but more on how and frankly whether agencies choose to deploy their resources, however limited they might be. Certainly, for instance, at the CFPB, there's been no lack of headlines about the Bureau either shutting down or not requesting a budget, accepting a budget, being sued by its current employees to stay open, and so on. All of that is certainly important. In some cases, it's a parlor game here in Washington, D.C. But at base, the agency itself is relatively dormant. We're seeing significant constraints across supervision, enforcement, and rulemaking, and at times the agency signals it wants to remain dormant, and yet it persists in some areas, it has a regulatory agenda, but like the cadence of activity is reduced. Previously, a presentation like this for an outlook would have a whole host of regulations we'd be discussing, and today we've just got a handful. That doesn't mean the CFPB lacks authority, though. It just means that it's just not exercising that authority in the same ways it had in the past. And it's often harder then for compliance teams to really identify what that clear enforcement posture is and what the checklist might be. By contrast, the Federal Trade Commission remains active, but its role has always been different. It doesn't have jurisdiction over banking organizations, although it may with respect to other entities within an affiliated family. And the FTC is focused on investigations and enforcement, particularly around pricing transparency, subscriptions, financial products, and classic advertising and marketing, rather than just per se the intricacies of consumer financial services rulemaking or supervision. It has never had examination authority, for instance. And meanwhile, at the banking agencies, they're recalibrating as well. The OCC and the FDIC and the credit unions and Federal Reserve, they've all signaled in one way or another a bit of a retrenchment, looking at material financial risk and taking a sort of a targeted review with respect to what examinations may take place, as well as even adjusting thresholds as to who may even be examined on a regular periodic basis. So all of that really means that there's really a big shift as compared to, say, 2, 3, 4 years ago, and even during the first Trump administration. Now, as mentioned, there's a couple rulemakings that the CFPB has at least given some bandwidth to, and the CFPB is the one that plays the significant role in rulemaking. So, Jim, what's going on with respect to mortgage rulemaking at the CFPB?
Yeah, Jonathan, I mean, you touched on it. There's definitely a shift. So there's a lot less rulemaking that the CFPB is engaged in, but mortgage is one of those spaces where there's a bit of activity. So, and there's obviously a question of whether the CFPB has the resources to actually go through with these. But a lot of these mortgage rulemakings originate from the spring 2025 regulatory agenda that the CFPB put out. One of them would be streamlining the mortgage servicing rules. So if people recall, back in 2024, the Rohit Chopra led CFPB proposed to amend the mortgage servicing rules to streamline loss mitigation procedures. And the proposed rule would sort of allow mortgage servicers to offer repayment assistance to borrowers earlier on than under previous rules. The CFPB indicated that change was kind of within a final rule stage. So it suggests that the CFPB is considering actually moving forward with the rule. Don't believe we've seen any action there yet, but we could see some action this coming year. On another front, the LO comp, loan originator compensation, and discretionary mortgage servicing rules are also things the CFPB has mentioned focusing on. So kind of at a high level, the LO comp rule was designed to prevent steering in mortgages, tying of mortgage or loan originator compensation to mortgage pricing. The CFPB has talked about rescinding that rule because it's been difficult to comply with for people in industry. And then kind of along the same lines. The discretionary mortgage servicing rules are, they're out there. They talk about how mortgage servicers actually implement things like delivering periodic statements, delivering loss mitigation to borrowers, things of that nature. And the CFPB, it's unclear what they would want to do with those rules, but there's some indication that the CFPB might rescind them or otherwise narrow the scope to only those things that are within the statutory scope of what the CFPB can do. So those are kind of two of the bigger actions on the mortgage side. Obviously, things like QM, they published a new QM threshold this past December. There's been a little bit of a kerfuffle over whether the CFPB is going to continue publishing the average prime offer rate if it were to run out of funds. That's really important for people to determine whether a mortgage loan is a higher priced mortgage loan or not. But ultimately, the CFPB has received some interim funding, so it looks like it'll continue publishing that rate. And so, in the mortgage space, there's a little bit of an indication of things that are happening, but we'll see what actually happens this coming year.
Well, outside the mortgage space, there's other CFPB initiatives that also remain unresolved. This Section 1071 rulemaking that would require lenders to collect and report small business lending data, creating significant operational lift, is still an open item, essentially. You got Section 1023. Also, the 1033 rulemaking had been sort of in process for over a decade. Often described as the open banking rule, governs consumer data access, sharing and that has unresolved questions around security, liability, and consumer control. The CFPB has signaled that they're interested in still tackling that, but again, we're not. There hasn't been a final announcement around that, and again, some of the agency's capacity to address the rule has been called into question. And then the CFPB's effort to define abusiveness under UDAP, essentially rein in the use of abusiveness, at least plant the flag, is something that could be out there too. There's also some non-bank larger participant rules that are essentially administrative at this point to shape expectations of when and how different markets are defined. But at the end of the day, shaping the expectations, even when supervision is quiet, may end up being the tree that falls in the woods that doesn't make much of a difference. But that being said, the takeaway right now is that really uncertainty around timing, and there's always uncertainty around rulemaking, but this is perhaps even more so, breeds even more uncertainty, not necessarily relief, and in some cases, a lot of it is TBD. Now, there is places, though, where federal risk still manifests. Even with limited visible activity, the federal risk hasn't gone away. It shows up indirectly. We see it in legacy matters, unresolved inquiries that are in the process of perhaps being wrapped up, contractual expectations, bank partner oversight, diligence and reliance on or not from federal agencies by states and private litigants. Certainly, the CFPB put out a ton of guidance over a decade plus that is still out there. It's still available on the CFPB website, and it certainly seeped into what some of the states are doing and some of the private plaintiffs' perception of how the law should be interpreted. Now, what has changed for compliance teams, we think, is really that the environment changes how work gets done. We see it in our practice, and we're certainly on the legal and compliance side in-house, we're hearing from folks that with less federal engagement, there really is, potential less clarity and more need to exercise and document judgment. We think there's more of an increase on internal risk tolerances and governance processes, documentation, and understanding not just where the line might be today based on what the agencies are signaling, but on where it could be in the future. And what has not changed is at the same time, the statutory obligations remain, advertising, disclosures, and complaint handling remain a perennial risk area. And the FTC remains an active federal player, as mentioned before. And so as a result, there is still a need to exercise judgment. Compliance decisions might be less now about checking the box, but they are about making reasoned calls, often without definitive guidance that's current, and being able to explain those decisions and why they were made later. If anybody remembers 2012, 2014, 2016, there was a lot of activity by the agency, CFPB at the time, and even the FTC, of looking backwards. And there is the potential for regulatory snapback. Now, in the meantime, where is risk coming from? And it's might be, with the federal backdrop, but the risk is really mitigated outward to state attorneys general, state regulators, multi-state exams, private litigation, and counterparty-driven scrutiny. The New York Attorney General, for instance, has new full UDAP authority under the Fair Business Practices Act that was just enacted. The California DFPI, of course, has full UDAP authority, and as well as also a full slate of periodic exams in addition to investigations using that authority and its licensing authority as well. So the center of gravity has really shifted outward. It's migrated outward. It no longer is solely focused on Washington or being driven from Washington. At the same time, UDAP theories really still seem to be the central risk area. The standards are intentionally broad, and as mentioned, states like California, New York, others have that authority or can use the Consumer Financial Protection Act, the Federal Consumer Financial Protection Act, to push their expectations through exams as well as also investigations and enforcement, not just necessarily substantive rulemaking. So a key shift in focus is understanding where the risk is coming from, but also the lens through which they're looking at it from. And increasingly, we're seeing states, whether it be regulators or attorneys general, using the old CFPB playbook. Now, regulators and investigators are really testing proof of compliance in operation. Anecdotally from the field, we're seeing a lot of scrutiny over whether systems, controls, governance actually function the way they're supposed to not just meet the letter of the law, but also sometimes the expectations of whoever might be doing the scrutiny. And as a practical matter, I think it's important to note that preparation is key. While you might plan for continued CFPB activity in most markets, assume that state and private plaintiff scrutiny remains active. Even Rohit Chopra, former director of the CFPB, is now coordinating and assisting Democratic states attorneys general. And even New York City now has a former FTC consumer protection head, Samuel Levine, running its Department of Consumer Affairs. So again, risk has shifted. And of course, we would suggest avoid dismantling those controls before just simply because they were built for federal expectations. Document those decisions, and the risk of snapback remains a real possibility at some point in the future. As Sarah mentioned, with perhaps a split Congress, more oversight hearings, and then of course, we're less than 2 years away or thereabouts from about 2.5 years away from a presidential race and therefore an election. So with that, I'll turn to my colleague, Andrew Bigart, on payments and market infrastructure.
Great. Thanks, Jonathan. And I think while, there may be less happening to a certain extent at the federal level, as you talked about, there's a lot happening, I think, from an industry perspective, and particularly in the area of payments and related kind of markets. And so go ahead and go to the next slide. We'll talk a little bit about kind of both industry developments that are happening as well as regulatory ones over the next few slides. Just starting with some general trends, kind of some of the hot areas or buzzwords that we're probably all thinking of. At the top of that list, we've got here agentic commerce. And that is, for those of you that haven't heard of that term before, Essentially, it's online shopping that is carried out by AI agents that are operating on behalf of a buyer, where they're able to kind of autonomously go out and search, compare, and engage in a purchase transaction with very little user oversight or intervention. And looking back over the prior few years, maybe we've got digital assistants that we've used to make purchases, et cetera. But this kind of agentic commerce really has the potential to operate on a much grander level, where agents can go out and engage in all sorts of transactions on behalf of consumer or business buyers with not a lot of oversight. And then there's been a lot of developments on the industry level and pushing this forward. If you look at the card networks, they've been coming out with rules on how agentic transactions can operate over their networks. You've had other industry players in kind of the marketplace and platform side looking at the experience and how those transactions work. And so that's going to be a big area to watch. I think there's still going to be a lot of questions on kind of liability allocation between merchants, platforms, processors, and how they manage that, but certainly an area to keep an eye on. Another topic which my colleague Chris is going to talk about more in a few minutes is just stable coins as being a growing use case, not just for cross-border, but even potentially for, coming up soon, merchant transactions, more kind of everyday use of stable coins. Obviously, there's been an evolving framework, as Sarah mentioned, and as Chris will go through. But I think, how do stablecoins actually get built out moving forward now that we have some regulatory certainty is going to be interesting to watch. And then finally, we're seeing digital wallets continue to grow as a payment method. And there is some tension there when it comes to how do banks and wallet providers and others all work together? What kind of data do you have access to? I think Jim or Jonathan mentioned the CFPB's 1033 rulemaking. That obviously plays a big role there. So those are some of just kind of the hot topics to keep an eye out on, but there's certainly a lot of other developments we need to cover as well. So next slide, please, Jonathan. On the card processing side, there's two developments just to kind of flag quickly. One is Visa has been continuing to update their bank acquirer monitoring program, where they essentially have consolidated various fraud programs into a single program for managing fraud and disputes through the networks. And that is a development that is causing a lot of operational needs at acquiring institutions, making sure that they're complying and implementing to meet these new requirements. So that is one area to track. There's also been potential settlement in Visa and MasterCard class action. Still hasn't been finalized yet, so we don't know exactly how that's going to play out, but it is looking at the rules around honoring all cards, some of the surcharge rules, and related interchange type issues. So if that gets finalized over the coming year, that could also be a big development to keep an eye on. Next slide. Oh, and also just to mention briefly, there are also some NACHA developments. So if we switch to the ACH side, not just cards, but NACHA has some new rules coming out that require ODFIs, originators, and other third-party service providers to implement additional fraud procedures to try to cut back on false pretense transactions like business email compromise. So those rules go into effect in March and June of this year, depending on the amount of transactions an entity engages in. So that's something to keep an eye on as well. I think we continue to see a lot of interest in merchant surcharges, right? So these are different types of fees that a merchant may assess to consumers or businesses in order to offset some of their processing costs. There's just been a lot of interest in that. Continues to be something that's looked at. But while it's allowed under federal law, there's a handful of states that either continue to prohibit it or at least regulate surcharges, whether it's kind of specific disclosure requirements or a cap on what the surcharge may be. And there's also card network rules that are consistent with that as well. And then states are kind of enacting honest pricing laws, which require full disclosure by merchants of kind of all the fees you have to pay in connection with the transaction. So together, these developments, they make for a little bit of a fragmented and sometimes challenging, but possible means for merchants to implement surcharges in a way that can allow them to recoup at least some of their processing costs. Next slide up forward. I think you went back there, Jonathan. And one more. Oh, and so on the regulatory development slide, on the prior slide, Sarah already mentioned some of the potential legislative changes for the Credit Card Competition Act, for example. There's also kind of been litigation and potential rulemakings on Durbin, impacting kind of the interchange fee caps for debit. These are policy developments that are definitely worth tracking if you're either on the debit card side or if you're a card issuer. Next slide. I feel like we talk about this every year, and it continues to be relevant, is that the bank regulators at the federal level, and the Federal Trade Commission, and back when it was more active, the CFPB, they continue to look at banks and payment processors and to hold them kind of responsible if they are actively and knowingly facilitating fraudulent merchants and giving them access to the payment system. And that continues to be an enforcement area. We see the FTC continue to be focused on that. And we've seen the bank regulators be interested in that as well. And so particularly if you're a bank or payment processor that's working in higher risk verticals, where there is maybe more potential for fraud, higher chargebacks, et cetera, you need to be careful with that. Make sure that you're doing it carefully because the regulators are watching there. And if you go to the next slide, there's always, every year there are newer, new categories, what we might call higher risk industries, right? And some of the most recent ones are prediction markets, peptides, social sweepstakes. These are all kind of newer developments in areas that are being looked at as maybe having some higher risk if you're providing processing and related services for them. In part because if you're looking at prediction markets and social sweepstakes, there's uncertainty around what's the regulatory framework for this, and are these operating within clearly defined regulatory requirements. When it comes to things like peptides, it's a lot of what we see with other kind of supplements and food related products, which is what are the advertising and marketing and the health claims, et cetera, that are being made. So those are just some examples of kind of continued higher risk industries and newer ones as well.
Thanks, Andrew. And today's CLE code is Tailwinds 2026, no space. Tailwinds 2026, no space. So what Andrew just walked through shows how quickly payments are evolving with existing frameworks. Crypto and digital assets raise many of the same questions, but they're pushing them further. And not only are they falling within existing frameworks, but also some new frameworks as well. We'll turn that over to Chris now to explain what's going on.
Thanks, Jonathan, and thanks, Andrew. So now as we move into the digital asset space, there's been a lot of activity in 2025, and that is continuing in 2026. So the first thing I want to talk about is the Genius Act. That was passed and signed into law in July, and it lays out for the first time a national regulatory framework tailored to stablecoins. It doesn't fill in every detail. A lot of that will be fleshed out through rulemaking in the years to come, but it does tell us the main guardrails. And so kind of briefly going through some of the highlights here, we have a licensing regime. It includes banks via the subsidiary. Non-banks are also permitted to be issuers, but they must apply, including the banks, credit unions, and non-banks. Anyone who would like to issue a stablecoin under this framework must apply and be approved to issue the stablecoin. So that's like at the highest level what this act does. There's also notably a shot clock feature, a 120-day shot clock, where the regulator will have to decide on an application, either approve or deny, within that 120 days, or the application is deemed approved. And that's really cool because it forces regulatory action on those applications. Of course, another really kind of big part of the act is the reserve requirement. So each stablecoin has to be backed 1-to-1 with reserves. And that seems intuitive, but that wasn't necessarily always the case. Also, redemption is a very strong emphasis in the act. It is essentially it's a consumer protection type of issue where if people don't have faith that they can redeem their tokens, their stable coins, for the underlying value, then the whole system kind of breaks down. So redemption is a huge part of the bill. I won't go through each of these different issues. You can read them. There's a lot more, but we have a lot to kind of get through. So if you can advance to the next slide, Jonathan. So there's been a lot of activity at every single level, but one thing I want to kind of focus on is this DOJ memo. So the Department of Justice in April last year issued this memo that completely kind of reorients how the department looks at, investigates, and approaches cryptocurrency-related cases. The core message really is that the DOJ is stepping back away from enforcing violations based on what is called, vague or unclear regulatory obligations, rather than clear statutory violations. So, kind of in the purest sense, this means the DOJ is pulling back from registration failures and compliance errors that can be chalked up to human error or other kind of more mundane types of issues. And instead, they're focusing on core kind of criminal activity, terrorism financing, narcotics, cartel activity, and that kind of sort of stuff. The memo also dissolved the DOJ's National Cryptocurrency Enforcement Team, which had previously served in the prior administration as the kind of aggressive arm of the DOJ in crypto enforcement action. And then kind of quickly on the banking side, there have been that Federal Reserve, OCC, and FDIC have all taken, the hints from the administration to relax their approach to how they view banks' role in the world of cryptocurrency. So each of these agencies and arms have issued interpretive letters and opinions that have weakened some of the prior requirements. For example, the prior approval requirements for banks for engaging in some of these crypto activities, such as custody, for example. And this is all in an effort to normalize crypto within the kind of traditional payment system. These changes are really aimed at reducing the barriers for banks, but they still emphasize the need for strong risk management. So this is the big ticket item. On the legislative front, there's been a flurry of activity on general market structure regulation. Last summer, the House passed the Clarity Act, which would have created a federal framework for the treatment of digital assets, clarifying that SEC-CFTC boundary. This exact piece of legislation hasn't progressed in the Senate. Instead, the Senate has crafted and is crafting its own version on two tracks, with the Senate Banking Committee focusing on the SEC and security side, and the Agriculture Committee focusing on the CFTC and commodities framework. On the banking side, the Banking Committee recently released a new draft text, and they were aiming for a January 15th markup, but that was postponed, and negotiations are still continuing on that. On the agriculture side, also recently this month, new draft text was advanced, and there's going to be a markup tomorrow on that side of the legislation. So we are really interested in watching what is going on with that and how it progresses, and we'll be sure to post on significant updates. And then finally, for the kind of cryptocurrency angle, if you'd like more information, we actually put together a webinar series on digital assets, and that's been designed to be kind of practical and implementation focused. And there are 3 sessions on our website, venable.com/insights. Particularly, we have all the slides and links to each of these 3 webinars.
Thank you, Chris. And, rather than walking product by product this year, we thought we're going to now take a look at where some of the risk is clustering around different markets. And to start it off, Jim Williams.
Yeah, so I won't go through everything on this slide. There's a lot of information there, but one of the big kind of exciting, I think, developments in the consumer finance space over the past year is the deployment of AI in a lot of really new and novel ways. Andrew touched on agentic AI in payments. That's been one of kind of the biggest areas of focus. There's a number of others on this slide. But one other thing that comes to mind, I guess 2 other use cases that come to mind, extremely dynamic machine learning based credit underwriting models that are dynamic to an individual consumer and that have multiple engineered variables based on a consumer and what they're specifically looking for in the credit context. And then in the servicing and collection context and credit, a number of servicers, collection agencies are using advanced machine learning models to predict the best way to get in touch with consumers, which channels to use, when to contact them, how frequently to contact them. Obviously, things like that are really exciting, but they can pose risk under existing consumer finance laws. And people in the industry have to be aware of some of the state laws and some of the changes at the federal level. So Jonathan, if you could move to the next, thanks. So this is kind of a high level breakdown of what's happening on the regulatory front that's specific to AI. Probably the most important recent development is the Trump administration's executive order back in December. It does a number of things, but the basic gist of it is that it's trying to create one simplified federal framework for AI regulation, and it wants to make that framework minimally burdensome on companies so they don't have to comply with 50 different state regulations. Uses a number of different mechanisms to do that. But over the coming year, we could expect to see a proposal and potential adoption of a uniform federal AI legislative framework. On the state side, they've been very active, particularly in the state legislatures. Many financial services companies are not subject to a number of the AI laws, AI-specific laws that have passed because they have exemptions for GLBA covered financial institutions and GLBA covered data, but there are a few that people should be aware of. Those are kind of listed to the right here, but just a couple in particular. The ADT laws, many states have passed them. Some states do not have GLBA exemptions, or they only have limited GLBA exemptions. So in particular, California's does not exempt non-GLBA data from that automated decision-making technology law. And so if you have a dynamic underwriting model like we talked about that uses some engineered variables that are not, consumer NPI, you might be subject to that law. And as a result, you might have to provide consumers with disclosure about the ADT system that they're using and some of the other things there. There are obviously existing financial services laws that people have to comply with when they use AI. There's kind of a list using one example on this slide. Won't go through everything, but when you're deploying AI in a new, novel way, you just have to keep in mind that the full spectrum of consumer financial services laws and regulations can apply.
And just a reminder, folks, today's CLE code is Tailwinds 2026, no space, TAILWINDS 2026, no space. Andrew, earned wage access is getting a lot of attention by the states and even the CFPB.
Yeah, I mean, I think earned wage access is a really great example of how you can have innovation uh, in an industry, and then ultimately regulation does catch up, right? So earned wage access as a product has been around for a while now, but really over the last 2 years and really speeding up into like, last year and continuing through this year, we've seen a lot of regulatory changes. Very quickly, earned wage access is a product that allows workers to get early access to their earned but unpaid wages, right? So if you get paid on a 2 week cycle, you can get wages that you've earned, prior to that 2 week payday period. There's two different models that are out there. One is what they call the employer integrated, where the provider of the earned wage access integrates with the employer, and kind of the repayment of the advance goes through the regular employment paycheck model. And then you've got direct to consumer, where you have companies going directly to consumers and getting repayment on advances from the consumer's bank account. Um, at the federal level, there's been, the CFPB has issued guidance that has kind of shifted over time as we move from administration to administration, but at least confirming, the view for now that the employer integrated, for example, are not subject to Federal Truth in Lending Act, TILA related requirements, but that doesn't mean that states necessarily feel that way. And one of the biggest developments has been there's been at least 12, if not more, states that have passed kind of licensing requirements for earned wage access providers. And they apply pretty broadly, whether you're involved in employer integrated or if you're doing the direct consumer. These licensing are like a lot of other state licenses, where you have to apply, submit a lot of corporate information, go through that whole process. And then once you are subject to the license and you have it, there are disclosure requirements, reporting, examinations, et cetera. If you go to the next slide, I mean, what we've seen in terms of the big issues with earned wage access for the most part so far, is especially for direct to consumer, some of the fees that may get charged can get very high when you look at them on like an APR perspective. That's raised concerns from in a number of different enforcement actions. Even on other models, that maybe have free options. There can be concerns that if you charge, fees for expedited delivery, how does that get regulated? And how do you manage that? And then just the general disclosure that goes along with making sure that the users understand how the product works, what fees apply and when. These are all things that have led to some enforcement. So I think, earned wage access has been one of the more active areas when it comes to regulatory developments. And it's really been driven a lot by the states over the last year or so.
Thank you, Andrew. And of course, in compliance considerations being important there, EWA is still very much an evolving state landscape too. So we'll turn now just very briefly to 4 areas that continue to receive attention, and we think in this coming year will also receive attention. Buy now, pay later. It's no longer novel, but the regulatory focus has really shifted to not whether it's permissible, but how the existing consumer protection frameworks apply. Several states have taken an interest in BNPL, as they have actually even in the past as well, and there's some pressure points there. On the consumer reporting and data use, accuracy and disputes continue to be a focus of regulators. We see it in examination situations, and we also see consumer reporting risk generally. It's durable. It's very process driven. It can be very technical, and in examinations or investigations, it's something that people can easily understand whether or not things are being processed the way they might need to be pursuant to the law. Advertising and lead generation, a perennial. It's a multiplier across all consumer financial products. Substantiation of claims remains key. The data sharing risks as well are present. And the oversight of affiliates, marketers, the lead generation community generally, by counterparties and other stakeholders in it, remains paramount. Just in exams, for instance, across several states, we always see the questions: who are you purchasing leads from, or who are your advertising partners, something to that effect. And sure enough, then those advertising partners end up part of some sort of scrutiny as well. Whether or not anything that is ever alleged is not the point. It's on the radar of regulators. And then debt collection and debt buying and debt relief, again, also a perennial. In that space, California DFPI has been extremely active, not just with debt collectors and debt buyers doing licensing exams, but also now licenses debt settlement organizations, which are undergoing exams too. You've got a whole host of issues there, many of which had started and percolated at the federal level, at the CFPB and the Federal Trade Commission before that, and states are now bringing that type of scrutiny on board. So transactions and partnerships are really an interesting dynamic here. You have a situation where connecting these regulatory themes to partnerships and structures permeates. And so, Jim, thoughts on that in terms of the market dynamics and the regulatory landscape?
Yeah, at a really high level, I think there are two really interesting market dynamics that are playing into the regulatory landscape. I think the more important of the two, frankly, is the column to the right, which is transactions are driving deeper regulatory due diligence at the moment. The transactional environment remains robust. There are a lot of capital markets transactions happening, particularly in the lending market. And those transactions, whether it's the securitization, getting a warehouse facility, an M&A deal, something like that, they're all requiring deeper levels of regulatory due diligence that are requiring companies to continue to maintain a strong compliance management system. In particular, have a really strong change management program to deal with new state laws. Now that, as we've talked about, some of the emphasis is shifted to the states, and also to have very experienced regulatory and compliance personnel who can handle a changing environment like that. Also, obviously, some transactions trigger change of control filings, and that can be a challenge and requires a lot of effort for companies. And then on the other end of the spectrum, banks and fintech companies seem to be merging a bit. The two markets are converging. So fintechs, there are a number of fintechs that are pursuing bank charters. Off the top, Affirm pursuing an ILC in Nevada, Nubank pursuing an OCC national bank charter, and then of course the crypto companies that Chris mentioned. There are different reasons for all of those, but in general, it's become a bit easier. People feel to obtain a bank charter, and that's encouraged that activity. But at the same time, banks are moving into products that were traditionally more the domain of fintechs. And that's increased focus on regulatory compliance for those products. So just a really interesting environment where those two worlds have merged. And as a result, the regulatory world has merged as well.
Yeah, Jim, structure is now really a risk decision and not just a business one. But, charters, partnerships, state licensing, other non-bank structures, they all seem to be part of the menu of potential options now. There is a lot of overlap. There's possibilities in certain cases of preemption of certain state licensing requirements if one holds a charter. In some cases, maybe not. Really depends on scope of business and facts and circumstances. But for the first time in a long time, there is a lot of different options, and they're all potentially worth the conversation. And whereas in the past, some would have been sort of dead on arrival. So there's a whole menu of options. But how they interact, is extremely important too. But I think you're going to see organizations have a host of these rather than just put all their cards in one basket. And, for those attending live, again, we'll shield the CLE code one more time. And there's lots of opportunity and tailwinds in the consumer financial services space we expect in 2026. While federal activity may be limited, risk has really not disappeared. It's shifted. Judgment, documentation, governance create real advantage in this environment. And as we look ahead in the outlook for 2026, it's really less about predicting new rules and more about tracking where the posture of the organizations for enforcement and potential scrutiny is most likely to shift to next. The themes we talked about today this fragmented oversight landscape, state momentum, and really judgment-based compliance are likely to define the year ahead. For additional articles and presentations on this topic and related areas, check out CFS/publications at venable.com. That's venable.com/CFS/publications. We've got a lot on these topics. And I'd like to thank my colleagues, Andrew, Chris, Jim, Mike, Sarah, and our production team here at Venable, especially Molly, Rodney, and Lara. Reach out if you have any general questions or just want to chat. We're happy to take them, and we'll get back to you via email. Of course, don't send any of that confidential information you have. And please subscribe to our newsletter content and articles and presentations on our website or through YouTube using the links under the description. And on behalf of all of us today, I'd like to thank you for joining us.